My name is Terrence Stevenson. I'm the director for C-City. And this is our second installment of Techcelerate. Um, just to tell you a little bit about C-City and WTAA. WTAA is a member trade association, and we do work all across the state of Washington, focused on our tech industry, helping to support entrepreneurship, particularly with regards to startups and startup founders. We also do a lot of work with policymakers to help support responsible policies to help grow our innovation economy. As director for C-City, C-City is really focused on individual tech workers. How can we keep or retain bright talent, particularly underrepresented, underserved, and undercapitalized talent in the state of Washington and here in the Puget Sound region. This event today that we're really excited to participate in or to present is Techcelerate. And Techcelerate is really focused on how can we help empower folks with the tools, skills, resources to enter into the entrepreneur space. Whether you're wanting to do it as a startup founder or maybe you're already a founder of a small business or company and you're wanting to understand how you can better connect to the startup world. Or maybe you're interested in investing in a small business or a startup in some way as a tech worker. We're here to kind of bridge that gap and provide some resources. And so we're going to get started with a presentation presented by Venture Black and Executive Director Evan Poncelet, and then we're going to finish it off with a fireside chat. Thank you.
Thank you for that introduction, Terrence. And welcome everybody to the event. So just as mentioned, so we're going to do our intro to venture and do some question and answer, and then we'll do fireside chats. And so we're going to record all of this for posterity on YouTube, so this will be up on YouTube as well for folks to turn live. So a little bit about myself. So I'm Evan Poncelet. I'm the Executive Director of Venture Black, also Managing Partner, Founding Managing Partner of Greenwood Ventures, which is an VC fund for early stage venture founders from underrepresented backgrounds. And we invest in life sciences, SaaS, AI, data, and generally technology companies that have high growth, fast scaling business models. So Venture Black helps calibrate those discussions and inform people about venture, and is a flywheel for venture founders. We'll talk a little bit more about that in the presentation. And then we do direct investment in those founders through an angel investment accelerator. So we're teaching folks who meet the Securities Exchange Commission's threshold income or net worth to invest in startups. We're teaching them how to invest in startups. And through Venture Black, it's specifically Black founded startups that fit this high growth profile. So that's one activity we do for direct investment outside of the venture capital firm. So I'm a software engineer by training. So I worked here at Fluke and then down in the Bay for a decade working for Cisco Systems. And then after COVID, I came back to work with Down Community Land Trust, which we'll talk about a little bit in the presentation as well. And they have kind of a land mission to acquire, develop, and steward lands for Black diaspora, centered around a lot of the legacy of my grandfather's work, who he was one of the first electrical or credentialed Black professional electrical engineers in the country, and then also founded the Liberty Bank, which is first Black-owned bank in the Pacific Northwest, and then also the second Black-owned bank west of Mississippi in 1968. So we'll talk about that legacy in context of venture and in context of doing business at large scale. But yeah, so that's a little bit about me. So Venture Black's mission, so we connect, empower, and support the Black venture community. And so these are founders, these are investors, angel investors and venture capitalists, or service providers, people that are providing legal service, accounting service, any just general business support towards Black founders, to share knowledge, build relationships, and create opportunities so that we can have a thriving, inclusive startup ecosystem at scale. So we found that there are people doing business development around community, place-based lifestyle businesses, even growth businesses that'll get to like middle market in terms of annual revenues. We'll talk a little bit about what that means. But we didn't find, when we start off as a meetup group, support organization for people that were targeting building unicorns, like the next Microsoft, the next Amazon, a company that's going to have $1 billion valuation and raise significant capital from venture capitalists to do rapid growth, to develop $1 billion valuation company within like 6 to 10 year horizon. And then our vision, why are we doing all of this? Because we want to develop a world in which every ethnicity, gender is equitably represented and building, influencing, and benefiting from the venture scale startup ecosystem. So you may have heard of like the PayPal mafia, or people that spun out of the unicorn company PayPal to go on to found like Tesla, SpaceX, Uber, all these different businesses. And so we see those people having an outsized impact in society today, and creating large generational wealth opportunities, community building opportunities. So we want to make sure that all people are represented in that economic model that is the promise of what capitalism is. So first, thanks to our sponsors, so Terrence, who represents C-City, which is a division of the Washington State Technology Industry Association, and then also our one of our great grant makers, the Washington State Micro Enterprise Association. So a little bit about kind of the innovation ecosystem, and this is where venture plays, and how these big scale companies come together. So what Venture Black does, and this is kind of a model of kind of like how we take things from this frayed top funnel of ideas, people, entrepreneurs, organizations that coordinate infrastructure, and then bring them to ventures at scale that are reaching multi-billion-dollar market opportunities, and then having exits, which are getting acquired by other companies, or having initial public offerings on the stock exchange. So how do we start? So it gets in early at the funnel, oftentimes at the university level, sometimes just in community with mom and pop businesses. But we start with talking about discovery, invention, research, helping people with patents and different things like this, and then talking about commercial opportunities, go to market, different things like that. So we get everybody involved in those conversations. We do information sharing, education, and networking. And as we go through that, we have to look more at like, okay, well, what do these companies need in terms of capital to get developed? How are they developing the pricing models? How are they looking at what customers need and building things that customers need and are willing to pay for, as opposed to just building things that they think are cool ideas that ultimately end up being a lot of expenditure, but not a lot of income generation. So we help people get their kind of companies together that way, and then do direct investment through our angel syndicate. And so when we get down to that point, that's where we're really looking at the analysis and review. So creating a due diligence report, which is oftentimes kind of the first real social proof that early stage companies from underrepresented founders get as they're going out to do fundraisers. So our organization, through creating those comprehensive reports, gets other investors off of the blank page problem and out of a lot of the initial assumptions that they'll have about founders that don't look like them, where they see outsized risk as opposed to outsized opportunity. And then, once we've gone through and sorted out, angel investing, we also try to hold relationships for early stage founders so that they don't all have to go into the environment and hunt for relationships. They can just come to Venture Black meetings. There'll be venture capitalists, angel investors there, and people with relationships to angel investors and different things like that, so that it's kind of like cashing those kind of relationships, so people don't have to go all the way each time, and teaching people how to really navigate those relationships and build relationships of trust before they need them. Because all of the financing, the larger capital transactions behind getting early stage, higher startups funded. That all moves at the speed of trust and how well people know you, your professional acumen, and there's a lot of support around it. So the work we're doing is teaching people how to navigate the ecosystem, about conventions that exist within it, relationships that they can access within it, and providing access to those relationships. And then ultimately getting folks to market and relationships to venture capitalists. And then if everything goes right, getting to an exit event. So we'll go into what that looks like. And so here on this slide, I've got a couple examples. So you see Jeff Bezos, and I'm not sure who's just next to him, but this is the earliest stages of Amazon where they literally spray painted their name onto a sign. You can see by the age of that computer monitor, hopefully, but this is like, the 90s timeframe, right? So people often don't see the beginnings of things. And so another part that Venture Black does is show you what things look like before the polished end result, the things that we see 10 to 20 years down the line. So everything starts roughly the same way. People are just trying to see what works, testing it against the market. And there are a set of best practices around that that we coordinate workshops and things like that around as well. And then just below that, you'll see this Justin TV guy, this guy with the webcam strapped to his head. So this was the early beginnings of Twitch, which is a video game streaming platform. So they started off as a bunch of college buddies, their team that wanted to develop a calendar app, but they didn't know anything about building calendar apps, and they were competing against Google Calendar and against Microsoft and things like that. So they ultimately didn't do so well, but they were able to actually sell the business on Craigslist for enough money to buy a streaming setup. And what they did was they just strapped this streaming setup to one of their co-founders' heads and just recorded his daily life, just nonstop 24/7 recording. And they found that they had viewer spikes when they saw that he was playing video games. And so they were like, oh, well, that's interesting. What if we just did that? And so what if we streamed him playing video games? And that was how Twitch got started. They realized that there was a huge market for people just playing video games. And so, these pivots, these stories of the earliest stages of things, we want to showcase that kind of stuff and let people know where they are on the map and what's ahead of them, so that people can people can be secure in where they're at in their stage of development, in early stage of development, but then also project themselves into the successful future mentally. Because, these things from humble beginnings grew into multi-billion-dollar businesses. So who do we engage to do that? So we engage startup founders, investors, so angels and venture capitalists, advisors and mentors, people that have run the gamut of startup life and oftentimes exited, service providers and sponsors, as I mentioned, legal counsel folks, and then partner organizations. So we live in Seattle, a very rich ecosystem for entrepreneur support organizations that are set up to help build relationships, professional societies, meetup groups, and then employee resource groups of people that have built organizations around identity inside of like the tech firms or finance firms, or even like the hospital systems out here. So wherever Black people are, we're developing intellectual property, but then not getting the full benefit of it because we're selling our labor to our employers and our thoughts and ideas to employers, as opposed to owning them and really doing activities without having a way to fully own the fruits of our labor through our own companies, our own customers, our own revenue. So what is the impact of what we've been doing? So we're building more Black co-founders and first employees. Just the other day, I was at a startup studio where a young man who was developing an app that he hadn't quite launched just yet is now part of a Black startup studio, and they're developing exciting apps together. We've gotten a young man an internship at one of our investment companies, who's also a member of Venture Black, Doppel Technologies, which is the telerobotic ultrasound system. So getting those sorts of co-founder agreements together so that people can own equity in these high growth companies in their early stages through employment. We're pipelines for founder success. So like I say, helping people through each step of the journey. We'll talk about what those steps look like in this presentation. Getting people access to capital, so helping people raise money There's whole infrastructure around funding these early stage startups because it's a high risk but high reward activity. So people are incentivized to do it, and there's all kinds of tax benefits for doing so. And then we're also reducing the risk and increasing the value of Black startups so that they can have an easier time of raising capital, getting to market, and finding product market fit, and ultimately, getting to an exit or just scaling the monster company. And really, lastly, it's creating new investors, so pipelines to angel investment and venture capital for Black and Ally community. Why are we doing this? And so, in order to really get us to that vision of a future where everybody's represented equally in this sort of economic activity that has huge wealth gains, we're doing this to make sure that Black generational wealth is scaled through this global mechanism of regenerative startup founder investment. And so we can look at this from an economic ecosystem pyramid. So here, credit to Rodney Simpson from OHUB out in Atlanta for putting this together. So we see at the bottom, early exposure and socialization. So this is like, I'll just kind of go through it, and then the next slide will show more organizations that speak to these specifically. Building on top of that, initial exposure, then education and skills development, and these all part of like talent development. So we see the green stack is talent development, tan is new venture development, and then the blue is economic development. So in these categories, we see on top of education and skills development, we have talent placement, so actually getting people career connected learning. Then we get to innovation, which is really building out the next accurate skin color photography apparatus. And then ultimately entrepreneurship, so taking what you learned, right, the earn, learn, and return. So you go from selling your intellectual capital and your labor to Apple or Microsoft or something like this, to then ultimately owning the full share of your intellectual capital through entrepreneurship. Then from that, being an investor yourself in enterprises, in entrepreneurial ventures, and from that comes wealth and job creation. And that's kind of this virtuous cycle that startups and business development really allow. And so we see, different organizations like Mesa or First Reliable Competition, or what I came in Africa to work, which is the William Gross Center for Cultural Innovation, where we get youth exposed to early stage kind of technologies. So AI, make sure. AI, cryptocurrency, makerspace activity, and things like that. So physical manufacturing, getting people exposed to these future trends so that then they can go and get into university or places where they can, go to high level skills development. Ultimately, then they go from university to oftentimes the tech sector. So Black or Tech at Night will have a lot of folks working in FANG or different tech industry coming from these universities. And there's also people that make the leap straight to entrepreneurship and skip kind of working in the corporate tech landscape altogether and get a little bit of a kind of head start. So we see Facebook at the beginning of this, right? So that's the Zuckerberg move, right? Of using the little bit of college that he did do, and then doing a lot of, pre-work in high school to start a venture. And then we don't see him, I think, in this top picture, but that represents really this wealth of job creation, entrepreneurship, where you see, the people that are making decisions, for our country, really, from the tech firms that came from the humble beginnings. So you see a much older Jeff Bezos now in this picture, celebrating with J.D. Vance and Elon Musk, right? There's people that are making decisions for society, and decisions that are not precisely aligned with, I think, with the Black economic ecosystem development. So there's the saying of you give a man a fish, he eats for a day. You teach a man to fish, he eats for a lifetime. But then who owns the pond, and what controls are they putting around it, and what is the water quality of that pond, right? And who gets to survive off those fish? That's what venture really is about, is owning that pond, being the next Amazon that gets to own, South Lake Union, being the next Microsoft that gets to own Redmond, right? How do we get folks from the Black diaspora having that level of ownership and community support? And it comes from being intentional about doing that early stage venture development and supporting people as they grow. And why is this specifically important to do in the Pacific Northwest? So on the left-hand side here, we see that the Bay Area is #1 for AI jobs, and it's the #1 AI hub, but we're not far away second in Seattle. So we have the AI house that does amazing events centered around AI and developing skills around AI and building companies. But so it's a massive opportunity. So most of new venture investment is going into AI, and most investors won't even take your company seriously unless it has some kind of AI component to it, which is really now what the internet was in the 90s. So the White House got its first website in 1993. So we're kind of in that era of early rollout of AI, and that's where a lot of money is getting made. And then we are also in Seattle, in the Pacific Northwest, sorry, more specifically, the highest tech talent dense region of the country. So that's inclusive of the Vancouver ecosystem, but you can see, you know, where there's so many more tech employees per square foot of this place. And, you know, people come from all over the world, from the Black diaspora to come work in the tech firms. And so we need to make sure that those folks have community here and that they're able to grow and develop ventures, because the secret of why we're the most tech talent dense region is because we have a lot of great jobs and employers, but then also we have a great university system. So if you become an employer, then you can then become someone that has access to that tech talent pool to develop your company, and the reason why I call it tech talent law here is because a lot of these companies that are scaling at this rapid pace are companies that specifically grow off of like memberships or service subscription models, or they're accessing large markets. So drug companies or med tech companies that have like a built-in market of everybody that needs a hip replacement or something like that, right? Those large opportunities. So if you become an employer here that is building a scalable business model, attacking a big market like that, you'll have a higher, there's more dense talent here, so you can reach more people that can help you grow that venture effectively. And so why is it important for us to, when I say us, like folks from the Black diaspora, to have more ownership of the pond? And so, and I think this helps, you know, for allies and people that are looking at, well, why is it, you know, talking about, you know, such kind of Black specific kind of metrics? And the way to think about that is it's not to do with like any sort of, you know, notions of supremacy or anything like that. It's because Black people are really the most economically disenfranchised in this country. And so if we can fix these problems for Black people, if we can elevate Black people's ability to leverage these economic systems, then it's fixed for everybody. And so some data around that is only 0.4% of pre-seed stage funding goes to Black founders. And they, the next ethnic group up in funding is Arab Americans with 3%. So it's an order of magnitude gap from us to the next ethnic group, right? So if we fix it for the worst case, then everyone else will be able to benefit from the systems that we build to be more intentional about how these systems operate. And then on the investment side, only 1% of angel investors are Black, and only 3% of managing partners at VC firms are Black. So the people on the supply side of capital in these early stage ventures are also needing to be developed from underrepresented communities. And so how does that play out in the macroeconomic scene? So we see here a graph of home ownership across ethnic lines. And we see, if you look at the little gray area here between 1934 and 1944, that's the Great Depression. And so we see home ownership for the average white family drop to about, it's going to be 43% or so. And so that was, you know, one of the worst memories of suffering from that culture that is recorded. And if you look at actually Black home ownership, which is represented by the blue line, we have yet, well, we just barely started to cross what their home ownership percentage was in the worst and least stable period of economic development for white America. And so living in this prolonged economic depression without systematic, government intervention or really focused solutions, has led to this kind of a lot of the things that we see that are disparaging, in the media. And so we can own a greater share of wealth by building our own private economy and relying less on systems that have not been strongly motivated to help us over the years. So we see, just that, this last metric is as of 2014, but we're just starting to reach what white families achieved even during the Great Depression. So that aspect of the wealth gap is huge. And so if we look at the composition of the average Black family and white families asset portfolio, we see that Black folks are just getting on the property ladder. So it's 44% of their portfolios in home equity, as opposed to white families, it's 19%. So they have more varied blend of assets. We see that they have 23% of their wealth in business assets, which are they own businesses, right? We have 14% in business assets. And then we see that in terms of stocks, 8% and 2% likewise. And so this business equity, either private equity through early stage, not necessarily early stage, but through businesses that aren't yet registered with the Securities and Exchange Commission. So these are startups, these are your community lifestyle growth businesses that will go into more what those mean. White families have more exposure to those, and that's actually the higher performing asset class. So I'll show that too. So here we have the growth of $1 in public versus private markets. And then also you can see private real estate here. So we see that real estate has, would grow $2.14 if you invested $1 in 2015. But private equity and public equity from the S&P 500 or through ownership of like a startup shares in a startup, we see that $1 would have translated to almost $4 for private equity as an asset class, and then $3.5 for public equity. So here we see the distribution of household net worth by amount of net worth and race to the householder. And so for white and non-Hispanic householders, we see that the red graph here, and then for Black householders, it's the blue line. And so we see that we've got an overrepresentation of Black folks in the smaller income brackets, and in the mid brackets, we're actually caught up. So between 100,000 to 250,000, it's about a 2 or 3 point difference. Percentage point difference. But then as we get up to the higher net worth brackets, right, the things that below the average or below the bell curve, that's where there's the larger gap, and where Black folks aren't competing economically. So how do we change that? So if we get our asset portfolio to have more ownership of the higher performing asset class, this private equity piece, so these are our startups, investing in startups with founders, so how do we get access to private equity? Then that is the way to meaningfully close the wealth gap, right? So yes, people need to get on the property ladder for stability, but we cannot neglect these higher performing asset classes. So when we talk about venture building or venture investment as an economic activity, this is why that's important. And all of this goes into, like I was saying, owning the pond, which is what you can do when you make $1 million or over in revenue. You become like the next Black Microsoft or Amazon. These decision-making incomes really for society have to be built intentionally by Black community for us to be able to have a more secure future. And so what does that look like today, really without private equity? My mic, what's it? Hopefully, that might have been actually my transmit. I ran out of batteries. I got a spare mic here. That's okay. We'll go to the wired mic. So without private equity ownership and job creation to build opportunity, This is how a community looks. So we're giving the example of Seattle's Central District, which is represented here in 1960. The Black population of Seattle is almost entirely concentrated in the Central District. So each of those dots represents 25 people, and specifically the Black population. And so, yeah, the Central District was something like 73% Black in the 1970s or late 60s. And then, we see that it's actually gone down significantly to 2014. It's only 18%. And I think today it's more like 10%. So, Black Seattle has borne this huge brunt of, really the inverse of the tech boom. So we haven't been able to tap into that prosperity because we weren't building these large ventures, or we weren't owning the correct proportion of our building these ventures. We were building these ventures for other people in this region. We don't have the same kind of economic footprint. And so here we see also the red line around the Central District, which is this D4 here, where they say it's hazardous. So redlining was the practice in the 1930s of drawing these really circles around neighborhoods where banks could or could not lend for things like mortgages or commercial development. And so at the time that this redlining was going on around getting loans to housing, it was also going on with respect to how businesses could get funding. So it was when we when the Securities Exchange Commission, as a result of the 1939 stock exchange collapse, where the SEC said, okay, well, we don't want people to be able to invest in snake oil companies. So only smart investors, and we're going to say smart investors are people that have already gained significant wealth in the country. Only those people are going to be able to invest in businesses that are not registered with our organization, that don't meet our standard of excellence in terms of being able to responsibly use capital for business development. And so that put an economic red line around who could, fund high growth companies. And so we only just saw during the Obama administration some of that legislation change, but only slightly, to allow for crowdfunding. But angel investment, venture capital sort of stuff was really, we were redlined out of that as well. And so talking about redlining in the home district, so my grandfather is the guy in the bottom corner here. So he was one of the co-founders of this first Black-owned bank in the Pacific Northwest. And we see kind of some of the history around that, some of the people involved and some of the diverse community that was involved in really plugging that together. But this is what economic development looked like in the 1960s, right? In the era of great social change and the civil rights movement. But we've since moved on to this higher tech, high growth business paradigm. Venture capital was invented really in the 1960s, almost contemporary in Silicon Valley, taking its current format, enabling us to fund these more risky high growth businesses, leading to the current business landscape. And so a couple more sides of that. So this is the modern, what exists now from my grandfather's bank. So it was attacked viciously through the civil rights era, and ultimately fell into conservatorship over a bunch of lawsuits and different things like that due to disparagement by people at the top of the banking sector, the oversight committees that were run by the Black founders of Liberty Bank posthumously. But as a result, this was the beginning of Africatown Community Land Trust, where we were actually able to preserve a museum to the founders of Liberty Bank. Here you see some of the architectural elements of the bank were brought into building below market housing. This was originally planned to be a condo construction that would be affordable to Black residents in the Central District that are still standing to gentrification. But because of the advocacy work African was able to do, we were able to actually turn this building into a way to kind of stem the tide of gentrification. But it's not enough to stem the tide. We need to be able to get ahead of it through venture development. A few more other notable kind of Black Seattle achievements. So we have the Seattle Black Panthers. So if you see this famous photo of the Black Panthers standing, I think on the Lincoln Memorial, possibly Jefferson Memorial. The guy that is maybe in front of that image, that's Elmer Dixon. He's the founder of the Seattle Black Panther Party. And so if you see that photo, you might not associate it with Seattle, but that's one of our folks. And so Elmer Dixon recently wrote a book called Tie Standing that you can buy on Amazon. And so that legacy you see on the left is Carolyn Downs, who her clinic, the Carolyn Downs Family Medical Center, is the last of the 13 Black Panther founded healthcare clinics that's still in operation in our central district of Seattle. And to the left of that, you see Odessa Brown's Children's Clinic, which has gotten a redevelopment as well. And so I'll talk about that. So Odessa Brown's Children's Clinic shown on the left, the original one in the central district, and then the one on the right, which is in Othello. A little bit about Odessa Brown. So she actually was from Chicago, and she worked for, or was a beautician trained by Madam C.J. Walker, who was actually the first female millionaire in the country. So she happened to be Black, and her product line was around hair and beauty products. And so she had her school, and so here we see her factory, the Madam C.J. Walker Manufacturing Company here in Chicago. So Odessa Brown came here and was advocating strongly for children health outcomes. And so they were able to get through community action and advocacy the Odessa Brown Children's Clinic, which evolved into this larger center. But now imagine, right, if instead of having to just drive those outcomes through advocacy, if that was, you know, a foundation that was set up by a Black Amazon or Microsoft or Zillow, right? So that sort of private wealth can be leveraged more instantaneously to build these anchor institutions in communities of color. And then here's the work of advocacy work, actually my older uncle, Amari Garrett, who held by force was the longest civilian occupation of a building in US history. It was like 13 years. The Coleman School, which was a Black school that was being torn down in the Central District, and the plan was actually to build I-90 overpass to skip over kind of Black neighborhood and then bulldoze Black neighborhood like as a bypass kind of thing. And so he and a group of his peers held up by force against the police and intimidation and all sorts of things to ensure that either another school would be constructed or that there would be a museum to the achievements of Black folks in the Pacific Northwest. And so he was successful in that in building the Northwest African American Museum, which is there today. But again, this is, you know, a lot of, you know, extreme civic advocacy that has to be done. Whereas you see, you know, foundations building schools every day, right? So you see even in Black communities, some of the high wealth earnings from folks from the entertainment industry building schools and things like that today. If you build a company, you know, companies might be around 50 years or something like this, right? Because things change quite a bit. But schools and universities, right? These things have like centuries behind them. So, you know, taking out a school is kind of a big thing. And so our ability to build schools, to grow the beginning stack of the economic ecosystem is super important. But private wealth, being able to generate that, and private wealth generated from those companies is a good way for us to be able to build schools and accelerate our economic development. And so, you know, I'm saying that to talk about the value of business, doing business at scale. And so what does that mean? Since, you know, I can't just tell people to take a standing leap, right, to a billion-dollar company. So what does it look like to actually do that, right? So we'll talk about the systems in place and the graduated processes to get from an idea all the way to an initial public offering on the stock exchange, right? Where you see these billion-dollar valuations for companies. Oh, this is like unreasonably zoomed in, but we'll talk about it. So what we're doing here is classifying or categorizing businesses. So at the top, my laser pointer is the company, so I'm just going to indicate it. So at the very top on the left, we have the classification of a kind of business. So we have lifestyle, which is really owning your own job. Like these would be your freelance services, lifestyle blogs, more artisanal businesses. What do they function to do, and what opportunities lie there? Then we have this more growth business. And so this is, you're going after a certain kind of market opportunity and you're planning to grow at a steady pace to out-compete other people in the space. And so these are more your small businesses, your Planet Fitnesses, your McDonald's, your car dealerships, mid-sized companies, and these can do appreciable revenue. Oftentimes they'll get into the middle market of between $20 million to $100 million of annual revenue, which is good, right? We're not, talking about venture to be disparaging of those businesses, because those are, cornerstones of the community and significant, generational wealth builders. But then as we talk about ownership of the pond, right? What does it look like to get to $1 billion annual revenue, right? So that's this high growth, which is maximizing the opportunity. And that's what venture is about. And that's these tech startups, disruptive companies that don't have a NAICS code, that are building new markets, and that are exciting for venture folks, investors, because they're accessing these really large addressable markets of customers. And so at the top, on the left-hand side, we see different factors at each scale of doing business. So the top factor to consider really is just ambition. Like, what am I trying to do out here? Am I just trying to provide a living for myself so I can comfortably go on some vacations, generate a little wealth, maybe so that I can take care of my kids without, having to show up to an office at specific times? As we go into the growth sort of business, right, we're looking at more, okay, well, I want to generate the maximum amount of revenue and achieve increased profitability. So generating a much larger pool of cash and having employees is more important at this level, right? So if you want to be an employer and do this job of wealth creation, really this is where that growth business sort of thing kicks in. But then now, if you have gone and invested a lot of time in like tech education or getting a professional degree, then you also unlock this, and not all people can do this sort of economic activity, but you unlock this this more disruptive high growth opportunity, which is building new industries and creating new markets like Uber, right? That wasn't the thing. You had taxi cabs. But somebody was like, okay, let's do this thing that have strangers driving around in their cars. Being able to activate those sorts of opportunities and then gain wealth through that. So I'll just kind of go through some of the other factors here. So growth, what sort of funding they're going to rely on, what the risk factor is, so your ability to tolerate risk in your life, or with your capital access, and then the different scenarios for how you can capitalize when you're at the end of this economic activity, or the way to think about making money off of this. So oftentimes people that build these lifestyle companies, they're focused on maintaining personal ownership of the thing and control of it, and there's not really a succession plan in place for their kiosk business or smaller scale opportunity. It's just a revenue thing for the moment. For these growth businesses, they might actually make it onto stock exchange as their exit plan so that they can pass ownership to new hands, or sell their business because they've created a structured system of standard operating procedures and rules that aren't dependent on any specific individual. So they can then sell that business like you would sell a car, right? Their books are in good order. They follow general accounting practices. And so that's kind of the way people think about making money as kind of the end of their business activity in the growth business. But then when we look at venture, now this is where the expectation is more towards acquisition, IPO, and these are the primary goals. So they're yes thinking about growing the revenue of the business as a way to pay their salaries, but really where they'll make their salaries actually on selling their shares of ownership, or taking loans against their share of ownership, right, to finance developing the next hospital or developing the next school or developing the next country where they're going to do business in. And so those founders are thinking not just of selling to customers, but they're thinking of selling their business to a customer. So oftentimes these businesses will sell for upwards of 5 times the multiple of their annual revenue. So yeah, they want to get their revenue to a certain point, but then essentially able to sell 5 years of their business activity upfront. And so using that capital then to start something new or do something else with, you know, it enables them quite a bit, because ultimately time is the thing that we have is the most important kind of asset we can use. So I talked about, you know, the scale of doing these sorts of things. So I mentioned this word total addressable market. So when talk about the trajectory of these venture scale businesses, so really they're aiming to reach a significant number of the total addressable market within 10-year timeframes or less. The sooner the better, especially from an investment capital perspective. And also just like a founder perspective, because you can make money sooner than you want to do it. So the total addressable market is the total number of potential customers, people that have a need for that product or service. Then another way that they'll think about doing business in the nearer term is the service available market. So this is the total number of potential customers multiplied by the percentage of customers that you can actually service. And then and then the average annual revenue per customer. So that percentage of customers you can serve. So if you're an online business that's selling ski boots, you can only sell to people that are buying ski boots online. So your total addressable market would be everybody that's buying ski boots. Your service available market would be people that are buying ski boots online. And then your service obtainable market, this is like the nearest to what you're doing today. So this is really what you're going to do in the next 2 years. These are customers you can serve, but then the fraction of that market you can capture. So the fraction of snow boots companies or the fraction of the market of people that are selling snow boots or ski boots online. What percentage of that market can you actually capture? And so these inform your strategy for meeting your market. So how am I going to go after my service obtainable market? And then how does that lead to me being able to compete to get to my service available market? And then ultimately to the TAM. So the TAM is typically at nation scale. So the total number of people buying ski boots in the United States or something like that. And then once you're able to work at that level, then that's where you see people get to these transnational companies where they have either the market for Uber in, you know, Turkey or China or something like that, right? So you get to a TAM, and then once you're at that point and service the customers at that level, now you're in that $1 billion market. So venture is really looking at how to grow to that scale within 10 years, which is not an unachievable feat. So how does it get done? So we see this, there's a mechanism for doing this, providing the growth capital and mentorship necessary to do it. And hopefully you can see from the presentation slides, on the right-hand side, we have a graph or an infographic that explains a little bit of that. And kind of, it's like a little grayed out, but the idea here is that you start with 100% ownership of the company, then you give up some fraction of the company for people helping you develop the company, or for people giving you the money to help you develop the company. And so here we see the common evolution of this. So we start with you owning 100% of the thing. Then you have a co-founder that, you know, takes 50% of the company because they're going to give up their time for free to help you develop the app or build the prototype or whatever the thing's going to be. And this isn't the same as your first employee. This is someone that is actually going to be developing the company and growing it with you with the same level of, you know, time investment, things like that, right? And they're taking on as much risk as you are. So, but then we get to this point where you have the wealthy uncle or aunt, as the case may be, right? And so now you want to get some capital to pay for your server time or whatever the thing you need money for. So your uncle comes in here and they're like, okay, well, I'm going to give you $15,000 in order to buy 5% of your company. And so, now you're getting diluted down. So you don't own 50% because more people come in. And your uncle told you also that he's going to require you to reserve some shares for future employees that hire, since you won't be able to pay them immediately. So now your uncle owns 5% of the company. You do a little bit more work on your app using your uncle's money. You hit a few milestones. You maybe talk to some customers, have them test out your prototype or your minimum viable product. Then a magical thing happens. Now you're ready to go and pitch to investors. And these investors can allocate more significant amounts of capital. But what they're doing that on is the promise of some future value of your company, and specifically a limitation, so that they're going to get preferential investment terms compared to anybody else. So the idea here is you see that angel investors come in about 16.7% of this company. Everybody else has been diluted down some amount, right? But this is, they're saying, I'm going to give you $200,000 at $1 million valuation. So what that means is each one of my shares is going to be worth $1 million divided by 200,000. And so when you get to the next round, that's going to be the value of each of my shares. So I'm going to invest that money now, like saying that your company is going to be worth that much. And then that ownership will translate to some mapping to the next valuation, to where my shares will increase by, if we see here, the jump between a $1 million and a $4 million valuation, that's by a factor of 4. So an investor in that seed round, when you get to that Series A, then when the venture capitalists came in, their shares will be worth 4 times as much. So you can see why an angel investor would get into this, because now if they are able to, sell their shares at that point, I'm not saying they're going to be able to necessarily, if they're able to sell their shares to that next investor at 4 times the value, that's great, right? So usually they're waiting for the longer term. I'll explain how that unfolds here, right? So that seed round, oftentimes there's actually a pre-seed round. And that pre-seed round is more towards that $1 million valuation, or hundreds of thousands of dollars valuation. But like the average pre-seed raise, I think, is something like around $1 million in capital that people are raising these days. So these numbers are a little bit low when they were developed. That was a function of that time. But yeah, then as we go to this Series A round, and oftentimes this was like the first time, like there's been the accounting exercise of figuring out what the exact price, dollar per value of the company is going to be. So this is less speculative. This is less specifically to the deal making. There's still a negotiation there, but it's a, okay, we're going to put the actual quantifiable dollar amount, and I'll be able to sell my shares to another investor at this specific amount on the second year's market. So we won't talk about that necessarily, but at this price round, this is really kind of the you've made it kind of point as an early stage startup, where it really becomes a growing concern. This is a price round. And so here they're selling 33% of the company to a venture capitalist. Everybody else is getting diluted, including the angels that got in. The venture capitalist has bought $2 million or has invested $2 million in this company at a $4 million valuation. So now we see that a lot more people own this company, and then they've also brought on their first employee. So out of that $2 million, they're planning to pay maybe like $100,000 salary for this first employee. So now they've built out their app. Maybe this first employee is like a sales guy or something like this, or someone that's going to help them develop the app to be able to service more customers now that they found product market fit. And we'll talk a little bit more about that. But the idea is here, you see now that the founders are at 19.2% ownership of something that originally the founder, the guy that had the idea at the beginning, owned 100% of it, right? So, but why is that okay? That's okay because 100% of nothing, which is what the guy had at the beginning when it was just an idea in his head, is a lot less than 17% or 19% or, at the Series A round of a big company. So something that's worth $4 million, right? Having 19% of that is not actually a bad deal. So then, now looking forward to the initial public offering, and here represented by, I think it's the Empire State Building, right? So they made it, they're in the big office at the top of the thing. Now they've got a VC come in, or sorry, they've sold their shares to the public, 8.3% of their company to the public at a much higher valuation. So now that's a $2.6 billion valuation. Everybody's been diluted down, right? Not by a whole lot, but we see now each founder is down to 17.6%. And so 17.6% of a $2.6 billion company is actually a good thing. So to do that public offering, they raised as part of that public offering $235 million. And so if you can imagine, the scale of doing business, when you have $235 million to do, you can hire a lot more employees, you can build your office, put a nice sign on a big office tower, right? And build out your customer service department and really build a nice funnel for yourself.
So I have a question on this.
Can we hold on at the end and we'll go back there and do questions? If we look at that $1 billion IPO scenario, right? So who do we know that have done this, right? So here's the number of unicorns founded per year. So we can see there was a bit of a boom in the 2011, 2013 timeframe, right? So this was really when cloud computing became available. So you didn't have to invest so much in your own servers, right? You could build on Amazon Web Services or Azure, things like that. We can see, it varies per number of years how many of these unicorns come in. And as we come, in these later years, there's fewer and fewer of them getting done. But this is what you can see when we talk about the scale of doing business, the volume of doing business at that scale. And so 2015 saw 124 future unicorns founded, so that was kind of a big year. But an important thing to note is, as we look at all these companies, only 13 of unicorn companies in the country are founded by Black founders. So they're not quite represented here, but we have Calendly, Suzu, or Suze, and then there's a few other companies. I don't have that slide. I need to add this to this deck. But if 13 out of the maybe 1,000 companies here are black owned, they're doing business at that scale, right? We're playing small, so we need to be thinking bigger. We've made significant investment in STEM, and so we've been doing a lot of work through the Tech at Night series of getting people know each other. And so what I want to infuse in that conversation is the idea that we can leverage the talent and skills that we've been developing in the tech firms to build our own ventures and do what we see represented here. This is a chart representing the journeys that the founders of those companies came through. And each of these threads goes through kind of one of these eye hole points, right? So those represent common experiences of founders of these unicorn scale companies. These are those companies that get to $1 billion valuations and are represented on that chart to the left hand here. And so I'll go through a couple of the bigger kind of common shared experience. And then another kind of thing that the key to point out here is, so emerging markets is in green, and then in the United States is in blue. So if we're looking at unicorn company in the United States, those are going to be the deeper blue color. But so the common experiences that are almost shared between both groups of founders is a lot of the unicorn founders immigrated from a different country. They studied or worked abroad, went to a maybe not elite university, so just your garden variety university, that's the more common experience. Then they got a degree in science or engineering. Then with some got an MBA, some got other majors, right? But those are common pitch points. Then they went and got work in a role in product or engineering, or some consulting or biz dev marketing kind of role. Then they worked perhaps at the top 5, but technically did a lot of them. Didn't you see they take all these different paths? And then ultimately became entrepreneurs, right? So they worked at another startup, right? So that's a huge thing. So people that are founding startups are seeing how the sausage is made and saying, hey, I could do that. And then founding a company. And so the company you found first might not be the one that becomes the unicorn. And so we find a lot of times that these unicorn businesses actually founded by second or third time founders. I think the average is it takes 2.7 startups for you to get to unicorns. If you don't do it the first time, that's not an indication that you're bad at it. It just means that you've got to make sure you're learning from those experiences. What does it take to build a unicorn today versus what it might have taken a few years back? So we see that the time to reach unicorn status, which is that $1 billion valuation, has dropped from 6.6 years to 3.4 years from 2014 to after 2014. So that's really the cloud infrastructure availability time period. And so we see that the years to the first venture capital investment, and so I'll just go back real quick here to the slide where we talk about that stepping ladder. So the years to that first part where they get their Series A, where VCs come in and bought 33% of the company for $2 million. For a unicorn, that's typically happening within the first 1.1 years. So that's the average time it would take past 2014 to get that first venture capital deal. It used to take pre-2014 about 2.6 years. So you see a lot of people need to put those initial hours into building infrastructure or building, business plans that are more, what do you say, rigorous or something like that, right? There's less trust that people are going to even be able to do the infrastructure or account for the infrastructure risks. So it's just kind of easier to build something that a VC is interested in at this point. Then the years to actually achieve that unicorn status, to actually raise significant capital to be valued at $1 billion. Typically, that means you're doing $200 million a year of annual revenue, and they're looking at that from the 5x multiple. So the years to be able to get that $1 billion valuation before 2014 would take about 6.6 years. After 2014, that drops down to 3.4 years. So you, in your life as a tech founder, could hypothetically, within 3.4 years, build a company that is $1 billion valued, right? And so the first step, the hardest target to hit is the invisible target. So really what you have to do is get that experience of what making that target visible. And so we see that a lot of that comes from getting those product engineering roles, consulting business development roles, so you can really see how the sausage is made. And then it helps to go and work at a startup or to found a startup as an initial kind of precursor to building one of these unicorns. So that trains you to be the sort of founder that can achieve this unicorn status within that time frame. And so what are we doing at each of those venture steps here at the family and friends round, the seed round, the Series A? What is the focus of each of those steps, the stairs on the ladder to building those venture scale, building those $1 billion valuation companies? So here we're going to talk about in terms of the seed round, Series A, Series B, Series C, and Series D. So in that seed round, which are these earlier rounds, which are raised off of even safe notes or convertible notes, which are these promises of future equity, where if nothing happens, that you don't owe anybody any money. But if something does happen where you raise the price round, it becomes a more growing concern, then the people that give you that money, they get a certain number of shares in your company. So at the early stage, in the seed stage, when you're raising on those sorts of investment of legal frameworks, you're focusing on really building a product and getting to product market fit. So finding the point at which people want to buy your product almost at a faster rate than you're able to deliver it to them. So once you get to that phase where you're looking at maybe, oh, the market is interested in this person's product, then you're going to do this Series A or this price round where your shares get to a specific dollar amount. The previous ways that you're raising capital, these are convertible instruments. Some are just safe, which are more founder friendly. Some are convertible notes, which are loans that are slightly less founder friendly. So those can, when you get to this price round, those convert into actual shares. So that's an important event. And then people that are buying those shares directly that aren't converted from the previous round, what they're concerned about is, are these people able to hire of a team? And are they able to grow the revenue? What's their go-to-market strategy? How are they going to go through a set of milestones to make sure their revenue growth will get them to the Series B, which is scaling the team exponentially, getting that nice larger office, right, where everybody gets to work, and growing the revenue, proper sales channels and everything like that. So that's your Series B. At that point, you're really, selling, moving product, moving service, selling subscriptions to your SaaS service or AI service or what have you, or selling medical devices or any number of things. It could be even selling jars of pickled cabbage, what have you, right? People have all these different product-based businesses, service-based businesses that can grow and scale. So at that point, that's what they're looking at. Then in Series C, they're looking to see if you can maintain that profitability. So are you building in such a way that you're able to pivot through changes in the market? Do you have have you built a team and the culture of the team that can do that? And then that same concern is sustained to the Series D, where you're working at kind of the next level of things. And so, how long has it taken for these companies that we saw get to that $1 billion valuation to do what they did? So here we have a graph of when people first built their MVP, which is shown by the triangle, to when they have their first customer, which is the square, and then when they first felt product market fit. So that was when they were people were demanding their product or service almost faster than they could provide it. So we see, we'll pick like a couple of favorites here. So we see Canva. It took them about 1 year to develop their minimal viable product. And then roughly around that same year, they were able to get their first customer, and then it took off like wildfire. So a lot of people needed a better version of Microsoft PowerPoint. So that's what this presentation is on. And a lot of us have had great experiences with that. We'll look at Slack, which is a little bit more on the non-straightforward side of things. So we see that took 4 years to develop their first MVP, and then roughly a half a year to, or roughly a quarter of a year to get their first customer after that, and then really to feel the whole of the market took a whole half a year after that. So what happened in that 4 years leading up? Well, Slack was another one of these cases where people had founded one thing, but then found out that there wasn't a market for it. They raised a bunch of capital for it, and then had to pivot to doing a different kind of business. And then that led to them being a company that people ultimately wanted to buy from. So Slack was originally a gaming company. They had some kind of like massive online role-playing kind of game sort of thing. I can't remember what the name of it was, but they wanted to play their game. So they've gone up and raised $9 million worth of venture capital. I think actually maybe even more than that. I think it's maybe, I don't want to speculate, but they raised a significant amount of venture capital. I want to say in tens of millions of dollars. But when the market wasn't there for the product that they had, their VC, when they got to their last 9 million, the founder said, "Hey, look, we burned through all the capital that you gave us, except for $9 million, and people really don't want our thing." And the venture capital said, "Okay, well, we're not going to take the $9 million back. We actually invested because we really liked your team, and we know that you guys have what it takes to develop something. So use that $9 million to figure out, the thing that will actually work." And so they actually, because they were a globally spread out development team for the game, they had invented what Slack is, right, as a communications method to unite their dispersed team. And so they were like, okay, well, what if we sell that? There's nothing like that that's currently out there right now. And that was the thing that everybody needed, right? Before we had Microsoft Teams, before all these, other competitor platforms came afterwards. So Slack was really first to market with something like that. And that's how we got Slack, right? So if you fail the first time, right, provided that you're able to get the resources to take that risk, right, and fail and learn from that failing, then you can go on to build this unicorn. So it's not a one take sort of situation. It's working and pivoting and building the right team that can navigate those pivots and building processes in your business that allow you to be flexible in that way, and testing the market so that as soon as possible whether or not your market is there, and you can test that market before you even build a company, build a product or anything like that, through lean startup methodologies and things like that, which are things that we talk about at Venture Black. We'll actually have a customer discovery workshop on the 17th of this month with Pioneer Square Labs, which is a venture studio in Seattle. It's very prominent. How do we start there? So you can't read it, I think, at the top of maybe can. It says startup failing factors. And so what causes startups to fail is really problems with their ability to, these are, I think, successful startup factors. So what makes a startup successful? Let me just make sure, because I feel like that's oh, okay. No, these are the failures. So what will happen is the teams will potentially fail. And these are across IT industry, healthcare, and then all, so 50%, all is in red. IT is in the darker blue, lighter blue is healthcare. So looking across, diverse and then some specific industries where we see a lot of growth. What causes a lot of failure is like the teams, the business model isn't there, the technology doesn't pan out, the market doesn't show up. The industry is maybe a smaller opportunity. They're too early to market. People aren't quite ready for the product they're trying to develop just yet. So a lot of like blockchain stuff is kind of like sitting in that segment right now, virtual reality sort of stuff. A lot of it is like luck, they're just not having good luck. Actually, hold on, I'm pretty sure. One second, examine the slide a little bit because I can't see. Start there. Yeah, okay, so, but another thing that's not mentioned here is that they run out of money. So they're not able to raise capital enough to outweigh the burn rate of going through their capital, or they're not able to get to market fast enough or in a steady way where they're able to get revenue through customers to sustain their company. So they go under those ways. But so the two main ways are you run out of money. The rest of it is, things that will fall apart in any of these sectors. So why would an investor invest in a very risky startup? So we see here, the perennial Shark Tank, which I think is what most people get exposed to when they look at, these high growth venture companies that are selling products, right? How do they get the initial funding? So here, what a Shark Tank founder will say is, I'm seeking $500,000 for 5% of my business. That's what they say to the sharks, right? So how do we arrive at the valuation of a business? We'll say 5 goes to 100, 20 times. So if we take, 20 times 500,000, that'll be $1 million. That's what the valuation of the company is, right? So 500 on 10 mil is like this, what they're asking is this, the common parlance for it. So if we look at, now we're going to the investors head math, right? So we see that actually 50% of companies, or 56% of these companies failed. Something like 38% of them fail within the first 3 years. 35% of the companies they'll invest in will have like marginal gains. So like maybe they'll make their money back, or they'll get between 1 to 3x or something like that, or 1 to 5x. Now the more interesting scenario is when they can multiply their investment, they're going to return on investment 10 times as much as they invested, right? And only 9% of the companies they invest are going to do it. Some, as I mentioned, are just going to fail outright. And so here we see a pie graph of that kind of manifested across a portfolio of 35 or so companies in a Monte Carlo simulation they've done. And so here we see a line chart of returns that demonstrate that really only like 2 or 3 companies made it worth the while of all those other companies that they invested in failing. So we see here, we've got a peak of like 1,000+% in one company. We get to 1,000% in another company. And then, we get to 3,000% return on another company. So it's like, if they're putting $100,000 in these companies, 3,000% return on a, $100,000 investment is really good. So this is why such a high risk activity, it actually has significant infrastructure of investment. And so that goes through kind of like how we get through actually building ventures, what other people have done in venture, what the considerations are at each stage of the common way that these ventures are funded, which is that equity fundraising ladder. And then common experiences that other founders, just like potentially you, if you decide to use your time that way, have gone through life to get to being founders of these billion-dollar venture companies. So that concludes kind of the lecture portion of this. And what we'll do next is a fireside chat where Terrence will be asking me direct questions about it. And then I think actually Terrence had a few of his own questions if he wants to now ask them during fireside chat.
I had a question about one of the previous slides.
Oh, yeah, let me go back to them.
And there was a slide about founders and how it was, that one.
This one?
It was like the pie chart, this one. So when a co-founder, so someone decides to start a venture, and they find a co-founder, and they're splitting it 50-50. Are they splitting it 50-50 with the assumption that their percentage of ownership is going to shrink as more people come on? And like, how is that determined Like, are they making their agreements that I'm at 50 and anytime someone comes on, they have to purchase those?
Yeah, no, it's not quite that way. That's kind of the intuitive way you might think it works. What actually works is you print more shares.
Okay.
So typically you'll start off with 10 million shares of a company. When you go to incorporate, they'll ask you how much. And 10 million shares worth 0.001 penny each, right? And you just pay a franchise tax on that, which is keeps it around like $100 wherever you've incorporated your company. And then once your uncle comes along and wants to buy more shares and says that you need to actually have an options pool, what happens is you actually print more shares, so the value of the shares of the total ownership becomes less.
Yeah.
It's like inflation,
right?
Where more money gets printed, so the value of your money is less.
Right. Okay, that makes sense.
And so that happens at each of these stages, and so everybody keeps getting compressed. Now there are anti-dilution clauses where you can say, look, I know my product is the best. I've already got this great revenue to show for it. I don't really need your investment, so I'm not going to get diluted as a result of your investment. Any further dilution, everyone else will take the hit but me. So if you're in a position and where people are just like, well, I really want to get involved in OpenAI, so sure, that sounds good to me. You get to keep your 25% of your company throughout the whole thing. People will agree to that, but that's all based on your competitive position.
Okay, and I'm assuming all that is like done during like the contract and negotiating that you're stating.
Yeah, exactly. There's shareholder agreements at each stage of investment, or there's the convertible notes before there's like any shares exchanged, which are like in the future. That's what that $1 million valuation is like, you're giving me this amount in the future. Like I might have a higher valuation than this, but you're guaranteed the $1 million valuation. So that's how that gets done before things actually have a dollar per share value. More shares get printed. So
okay.
I have a question. This might sound weird. Can a person own equity in a certain sector of a company? So like, say somebody wanted to invest in just the tech side of the company, not necessarily the whole company, but they were like, I see potential in the tech side that you're building out. Although your product itself is not focused solely on tech. Does that make sense?
yeah,
Like Airbnb, it's like somebody could come in and want to invest in like the experience side of Airbnb. And then somebody else would come in and just invest on the tech side of it, like the AI side.
Yeah, it doesn't quite work that way, especially kind of at the beginning stage of company. But like, so you wouldn't necessarily be able to invest in like the tech side of a publicly traded company. You have to buy kind of the whole thing. And the reason why you want to buy the whole thing is because that tech side of the business, it relies on the brand value of the other side of the business. And so you really want to, from a marketing perspective, own the rights to that branding. Because aside from like just having a product that can do something that customers need, something like, I think it's like 60% of investment in companies actually goes to marketing. So make sure people know that your product exists. So if people know it by a certain name and then you switch that name out because like they spin the tech business out to a different business, then you might lose the value of that. So that's one thing. So you'll see people, if this does happen, what'll happen is that actually a private equity company will buy a whole company and then actually cut it up and sell off other businesses as separate businesses themselves. But it won't be the case that one business you can invest in a segment of that business. So yeah.
Then this makes me think that we might need to do another Techcelerate that focuses on like the patent. I have the idea. How do I protect my intellectual property? That's a whole. I'm sure that's a whole rabbit hole.
We'll do that, and we'll also have workshops about that. We've got great partners that fund companies specifically that need help with intellectual property and act as great advisors and can actually file patents and defend patents on their behalf.
Oh, nice.
And we'll probably have a workshop held by kind of one of those people.
Nice.
All right, I don't. I think our microphone situation might be compromised, but let me see if I can get that ameliorated just a little bit as we go into this. If not, we'll use the mic from the laptop here, and I think that might pick us up.